Let's talk about some numbers that are going to directly affect your wallet in 2026. The IRS just dropped its new inflation-adjusted tax figures, and we're going to break down exactly what they mean for you. And we'll start with a feeling I bet you've had before.
You know that feeling, right? You get a cost of living raise, you look at your bank account, and you just think, hang on, where did the extra money go? It's a super common and frankly frustrating feeling, and it actually has a name.
That whole phenomenon is called bracket creep. It sounds a little sneaky, doesn't it? Well, it kind of is. It can eat into your paycheck without you even noticing. But what is it exactly?
Okay, so picture this. Let's say you get a 3% raise just to keep up with 3% inflation. On paper, you're not any richer, right? Your actual purchasing power is exactly the same. But that little raise could be just enough to bump some of your income into a higher tax bracket. All of a sudden, you're paying more in taxes and you're actually taking home less in real spendable money.
And that is exactly why we're talking today. To fight this bracket creep, the IRS actually adjusts more than 60 different tax provisions every single year for inflation. So these changes for 2026, they're basically the government's way of making sure your cost of living raise doesn't turn into a surprise tax increase. So why these changes right now? Well, it all goes back to a couple of key laws. First, the Tax Cuts and Jobs Act of 2017, or the TCJ, really set the stage. Then, a law in 2025 made most of those changes permanent and added its own tweaks. The result is this brand new set of numbers that will apply to the 2026 tax year, which, just to be clear, is the one you'll be filing for in early 2027.
Okay, let's get into the nitty-gritty. We're starting with the numbers that affect pretty much everybody, the 2026 income tax brackets.
So the U.S. has what's called a progressive tax system with these 7 different rates. Now for 2026, the rates themselves haven't actually changed. But, and this is the really important part, the income levels that they apply to have all been adjusted upwards.
This table for single filers shows exactly how it works. And it's so important to remember this is a marginal system. A lot of people get this wrong. If you earn, say, $60,000, you don't pay 22% on all of it. No way. Instead, you pay 10% on that first chunk of your income, then 12% on the next chunk, and then 22% only on the amount that actually falls into that top bracket. By raising these thresholds, the IRS is letting you earn more money before you have to jump into a higher bracket.
And here's the full picture for all the major filing statuses. As you can see, the income thresholds are way different depending on if you're single, married filing jointly, or a head of household. Go ahead and pause here if you want to find your own situation.
All right, next up is a change that's going to make tax time a whole lot simpler for millions of people. We're talking about a bigger standard deduction. This is that magic number you can subtract from your income right off the top if you don't itemize. And check this out. For married couples who file their taxes together, the standard deduction is jumping up to a very nice round $32,200 for the 2026 tax year.
I mean, that's a direct bump from the year before, which is just great news. A higher standard deduction means more of your hard-earned money is shielded from tax right from the start. And for single filers, that new number is $16,100.
Okay, now let's shift gears and talk about families. Tax credits are amazing because they reduce your tax bill dollar for dollar, and there are some really important updates coming in 2026.
For 2026, the child tax credit is now $2,200 per qualifying child. But you know what the really big news here is? This credit is now going to be adjusted for inflation every year moving forward, which it wasn't before. That's a huge deal. Plus, up to $1,700 of it is refundable, which means you could get that money back as a refund even if you owe zero in taxes.
Another really key credit for working families is the Earned Income Tax Credit, or EITC. The maximum amounts have all been bumped up. As you can see, the credit gets bigger with the number of children you have, maxing out at over $8,000 for families with 3 or more kids.
So beyond those big ticket items, there are several other adjustments that could definitely impact your tax situation, especially if you're a higher earner, an investor, or a small business owner.
First up, the Alternative Minimum Tax, the AMT. You can kind of think of it as a shadow tax system. It's there to make sure high-income folks pay at least a certain minimum amount of tax. The good news is, the income level that's exempt from the AMT has been increased for 2026, so fewer people are going to have to worry about it. If you have investments, this one's for you. Income you make from investments you've held for more than a year is taxed at lower rates, and these long-term capital gains tax brackets have also been adjusted for inflation.
The key thing to see here is that for a single person in 2026, you won't pay a single dime in capital gains tax until your total taxable income is over about $49,000.
And for all the small business owners and freelancers out there, the qualified business income deduction is a really big deal. It lets you deduct 20% of your business income. For 2026, the income levels where this deduction starts to get limited have been raised, and that means more business owners are going to get the full benefit.
Okay, I know that was a ton of numbers, so let's just boil it all down to the most important points you really need to remember as you start thinking about your finances for 2026.
So here's the bottom line for 2026. First, the income ranges for tax brackets are higher, which is your best defense against bracket creep. Second, your standard deduction is bigger, which simplifies filing and lowers taxes for a lot of people. Third, key credits for families are up, and the child tax credit will now keep up with inflation. And finally, all those little adjustments for things like the AMT and business income mean the tax code is doing its best to keep pace with the economy.
And that about wraps it up. Every one of these annual tweaks, whether they feel big or small, has a real impact on our financial lives. So it kind of leaves us with one final thought. As these rules keep on changing every year, what's the one change that you'll be keeping a close eye on for your own financial future? Thanks so much for watching.